Εκτός από τους δύο ομιλητές, τους keynote speakers, στο πάνελ θα έχουμε τον κύριο Αλέξανδρο Μάνο, Διευθύνοντα Σύμβουλο της Τραπέζης Πειραιώς, και τον Θέμο Φιωτάκη, Senior Global Market Economist and Emerging Market Strategist της Goldman Sachs. Ladies and gentlemen, thank you very much again for attending our conference. I would like to start this last session and this last panel from the people that are more from the person that is in the theoretical side, Mr. Georgikopoulos. Mr. Georgikopoulos, do you think, you said that Greek banks should undertake stress tests regularly. Do you think there should be changes in that methodology? What have you to say about the criteria which are applied? Which parts of those criteria take into account that they have expanded in the southeast of Europe? How do you take that into account? And how can this actually help Greek banks to be strong in the future so that they will not have an Achilles heel anyhow?
First of all, let me tell you that I think, first of all, it's a very good idea, as I said before, the stress test to be compulsory for all the European banks. Of course, for Europe, the parameters of estimating or apply this test must be different. And a USA-style stress test may show or may not results about the European real problem of capitalization and capital adequacy and capital, if you like, good quality capital in order to support the risk coming from more risky region like South Eastern Europe and Balkan and, you know. Now, what I think, it is definitely very logical and necessary during this rough period to monitor better the risk and estimate in a better way the risk. Stress test is not a panacea. It's not something that will sort out all the problems. Although it would be a good idea for the commercial Greek banks to pre-estimate, to apply this test by their own, and then some specific criteria given by the Central Bank of Greece in order to verify the result. That should be the first, I suppose, priority when you are trying to apply this test. But as well, should be at the same time different stress tests for banks. They have different risk embedded in their portfolios. Regarding how, the stress test should be done according to how much exposure they have, in the regions that are more risky. Risk because of the country risk, because of the exchange rate risk, or maybe for the big deficit that they have these regions. But yes, I do believe that stresses should be done be more regular and more to be more programmed.
Mr. Manos, do you think, are you of the same opinion, and do you think that stress tests, one of which you undertook as Bank of Piraeus recently, should be publicized, the results, or not?
First, let me make an observation. We did a stress test for the Bank of Greece, which happened under the guidelines and criteria of the IMF. Previous to that, we had done a stress test for the Bank of Greece with guidelines that had been set by the Bank of Greece. We have done stress tests for pretty much every subsidiary that we have under the guidelines of the central banks, the host regulators, and and for Romania, Serbia, and Bulgaria under the guidelines of the IMF and the ECB. And we do our own stress tests, and we do them at group level, at subsidiary level, and sector level. The Bank of Greece has also asked us to do stress tests, for example, on the shipping portfolio, as well as the subsidiaries as the home regulator. In fact, we have an industry of stress tests, and what is interesting is that the assumptions that underlie each stress test amongst the home regulator, the host regulator, the ECB, the EIB, and which has also been involved in the IMF packages that have been being discussed for Serbia and Romania, and which I think are very helpful, and the IMF assumptions are different. In fact, the IMF assumptions that were used for Romania by the team that was covering the Greek economy were different from the IMF assumptions that were used for Romania by the team that was covering Romania. So one of the things that one needs to realize is that stress tests are very useful if there is some agreement on what the worst case scenario is. And as you correctly pointed out, when we have a lack of visibility, we should get prepared for the worst case scenario. But when we're talking about kind of like 7 or 10 standard deviations from normality, it's bloody difficult to figure out what the worst scenario is. We do not have too many occurrences of 1930s collapses in the situation. In fact, I think we probably have one, and we're now going through another one. And the economies that are going through it this time, where we are invested in, were not material at the time of the previous one. This is an unexpected event. I agree that we should be doing stress tests. Publishing them is a different matter. I do not necessarily agree that publishing the results of stress tests in normal circumstances is helpful. It depends very much on whether you think that the scenario that you're drawing is realistic and reasonable. If yes, then it is helpful. That is for the regulator to figure out, and the regulator to take a different stance to the past and ask for pro-cyclical provisioning. As you said, the Central Bank of Spain was requesting pro-cyclical provisioning, and although Spain is now facing a huge unemployment and a collapse of its construction sector, which formed a very large part of its economy, the banks there have a very solid capital base and should be able to withstand the brunt of the economic crisis in a much more comfortable fashion compared to banks that had been regulated by counter-cyclical regulators.
So, Mr. Fiotakis, please tell us, because you weren't a keynote speaker, what is your firm's take on the issue? Is Southeast Europe the Achilles heel of the Greek banking system?
First of all, thank you for the invitation. It was a very nice conference and very interesting things were discussed. I think Mr. Norris set the agenda very well. I think that one has to look at the numbers, and when looking at the numbers, you can see that the loan book, the loans that Greek banks have extended to Eastern Europe are an approximate amount of something like 18% of Greek GDP. Now, this means that it's about the same amount, the same percentage of their aggregate loan book. So if we make some quasi-realistic or sort of like our own type of realistic stress test that Mr. Manos says, as Mr. Manos says, depends a lot on the assumptions, but making some realistic assumptions about how these loans books can evolve, a realistic loss scenario or even conservative loss scenario would bring you to a loss rate of, more or less a very broad ballpark of 5 billion. Now, a 5 billion loss rate for the aggregate loan book is a pretty small amount for the overall economy. Obviously, some banks are going to be hit more than others, and there's going to be different parts of pressure. But overall, the amount is not something that is going to lead to a collapse. Obviously, the crisis could be much worse than we expect. But with a very conservative estimation, it's not going to be leading to a collapse of the financial system in Greece. That's one point. The second point I wanted to make is that potentially the source of risk for Greece is that the Greek banks have expanded in economies that are less mature within the emerging market universe of Eastern Europe, including the Balkans. That is both a blessing and a curse. A blessing, obviously, because in the long run, these economies are underpenetrated, as the chart by Mr. Norris showed. A curse because at times of episodes like this one, Bulgaria and Romania have been under the spotlight because of the potential fragilities in these economies. So putting it all together, the loss is potentially sizable, but not going to lead to a collapse of the financial system or of the economy on the aggregate. More importantly, if you compare this loss to so if you ask yourself the question, what assumptions do I need to make about the Greek loan book to reach a similar loss rate as the one I just sort of like discussed about that comes from Eastern Europe, you get a very, very, very small amount of percentage losses. So if you assume something like 2% losses on the Greek loan book, you get the same amount of losses as you get from the Eastern European loan book. So clearly, the risk of Greek banks is much more geared towards the Greek economy rather than the Eastern European economies. And more importantly, if you assume that there's a lump sum loss from both parts because of the crisis, the big question then becomes, which of the two blocks, Eastern Europe or Greece, will have better earnings growth going forward so that some of these losses are gained or earned back? And it's, to me, in my own opinion, it's pretty clear that Eastern Europe has a much better growth potential for the loan book rather than Greece itself, because Greece is going to go through a longer period of adjustment because of all these fiscal dynamics that our previous keynote speakers discussed, and obviously there's no reason for me to expand further on.
So this gets us back to the question about if we should really be looking at Greece or Austria rather than the southeast of Europe. The question is, Mr. Nourse, what do you believe? Do you believe that there is a risk in Austria? Is there a risk that is outside of Greece that will, if something happens in this area, some other area, that might have repercussions in the southeast of Europe and in Greece eventually?
Again, I think you need to be very careful when you're talking about these kind of potential issues. I think I also need to be particularly careful that I don't particularly know a lot about Austria. I do think, though, that it'd be clear to say that if there was a systemic failure in the Austrian banking system, it would have repercussions on the Greek banking system because of the exposures of the Austrian banks to Southeastern Europe and the corollary knock-on effect to the Greek banks that are in the same market. So I think, two steps back, you need to look on what's going on in Austria, but I think at the same time, as a Greek, you should be working in unison with the Austrians because you've got very similar issues. I think come back to the other central point of the question before, which I said before, is that the scale of the issue in Southeastern Europe, I think, is smaller in absolute terms than it is in Greece. So I think, again, they should be focusing in Southeastern Europe simply because of the lack of certainty and visibility on what could happen, because we just don't know given their recent history, as much as looking at Greece.
But again, we start, there is a cyclicality in the arguments about Southeast of Europe. Mm-hmm. Just 1 year ago, we had a conference which was called the Southeast Europe Banking Conference. Mm-hmm. Everyone was rosy about the area. It was very important for every bank to be there, mm-hmm. and banks were scrambling. So please take us to the future. Perhaps in 6 months' time, it's not going to be a conference calling the Southeast of Europe an Achilles heel, but again, a very big opportunity. Mm-hmm. So do you think that the opportunity there is bigger? Do you think that we should be collaborating, as you say, with the Austrian banks, or as Greek banks, we should be, quote unquote, wishing they are not as strong? So we do our capital increases like NBG, and we go there and buy the subsidiaries. How do you see these trends playing out?
Again, I think that's a complicated area. I think working for a German bank, you can use the word Schadenfreude. I mean, taking pleasure in the pain of others, I think in the current situation is not necessarily high on Alex's radar screen as a banker. I think that the reason people were scrambling for Southeastern Europe, again, because of the charts I put up, which is that there's under-penetration and you have to believe the macro story of convergence, and similarly, crossing into Turkey, which I think you could include in that equation. I think that there is opportunity for again, as I said at the conclusion of my speech, I think there is opportunity for the Greek banks if they can weather this storm, because I do think there's going to be a vacuum appearing. My point again I said about if I was sitting in Romania, would I think that in fact the Austrians, the Italians and the Greeks are the Achilles heel for their banking system? I think it's a very real one. If you have big crises in Dublin, if you have big crises in Lisbon, if you have big crises in Vienna, big crises in Milan, you're going to be withdrawing credit from the system. You're going to be shrinking your balance sheets because you have to. Therefore, if one can grow into those regions at the expense of others, that has to be a benefit. I don't think you could wish a systemic shock failure as a benefit.
So in order to do that, you have to have a good capital base. It is with great interest that the financial community in Greece learned after the NBG, has proclaimed that it will raise 1.25 billion euro, that a big part of that would be to substitute hybrid capital, and in a very intricate scheme where they had an offshore entity with 51%. So actually NBG had booked 500 million approximately euro in their capital, which they actually haven't paid.
Correct.
So the thing is, can we trust the data? This was not known to us, only the Bank of Greece knew it. So I'm not going to ask Mr. Manos about his bank. You as someone that has access to this data, and if we cannot pinpoint a specific bank, of course, but are there other surprises like that in the capital structure of the Greek banks?
I think the data are right. I'm not 100% sure that people that provide the data to the Bank of Greece, they should provide the data with some certainty that they are right. The point is not if the data are right. The point is if when we take the data and to apply some analysis on data, when we are trying to see what is the best, how can we manage to have the best capital aside, the better quality capital to avoid risk. I think National Bank of Greece did the right thing. Actually, they are going to buy back the hybrid capital and substitute the capital with a better quality. Now, I don't know if they are doing because they want to buy, to go and buy other banks or expand the activities in other countries. I am sure that part of this capital will be, they will keep it in order to increase the capital adequacy ratio. That is important right now for a bank not only to be big, but also to make sure that it will remain big for more difficult times. I do believe that the Greek banking system, doing these steps, going on through these steps, is getting stronger. Now, I don't know exactly what else they could do with other subordinated debt that there exist on the Greek banking system, and not only the hybrid. It's 1 billion of hybrid capital. It's a big amount for one bank. Other also capital inside the Greek banking system that they should be somehow changed, and they can substitute by even better quality, as I said, capital. I'm not against Tier 2. I'm not against capital that can be used for other reasons. I'm against for not so good quality capital to be used for protecting the system against unexpected risks.
So what is the perception, Mr. Fiotakis, of the foreign investment banks, of the capital structure of the Greek banking system? Do you trust it? Do you have data? Do you apply a risk percentage that you say, okay, there is an error factor that perhaps the Greek banking system is not as good as it's supposed to be, and you apply this to your calculations? How do you view our system in Greece?
We have a pretty big team that covers banks across Europe and across the world, and they do a lot of analysis. Obviously, they have their own ratios of adequacy, their own views about profitability, their own idea about how good quality the book is and how late or how early were the banks where the banks joining basically the Eastern European growth story. And it's up to my banking analyst has a strong and published opinions on that, and I'm not a person to discuss this particular point. I wanted to make a specific point relative to your question, that whatever you do as a banking analyst these days in order to see how fragile or how strong a financial system is, you have to take into account a macro analysis. So at the end of the day, you have to make some assumptions about how bad the economy will be, how that will translate into losses, and how imminent these losses will be, and what the ability of the bank will be to earn its way out of its losses. That's the macro, it's the backbone of any type of stress test, even the stress test that took place in the United States. And when someone looks at Eastern Europe from a macro perspective, they see a region that has very big cost benefits for investors. So they have very low labor costs, they have high productivity gains, and they have the potential to converge to other European economies. So they see a long-term growth story with very specific short-term risks that have to do with a very rapid sudden stop of capital flow into these economies. So basically, for Eastern Europe, you have growth potential, and you just need someone to finance it. And Greek banks, together with Austrian banks and Italian banks, have been financing this growth story. Now, the fact that you have this sudden stop of this capital is creating a growth issue for these economies. And also the fact that you have a slowdown in core Europe, which means that their exports are declining at the same time as their domestic demand, is another problem. So the key issue is that capital flow into Eastern Europe should not be interrupted. And that's the problem. The problem for Eastern Europe is whether the institutions that are currently involved in Eastern Europe are healthy enough to extend credit to take advantage of the growth benefits of the future. Now, for Greece, the situation is different. You have a much more penetrated market, and you have an economy that has exhibited very strong convergence up until now, but the trend growth trajectory in the future is probably at risk because of the high debt levels. So it's a very different story between the two markets. And if anything, the problem is with the financier, not with the structurally, not with the financier.
So, Mr. Manos, if you can be the proxy for the Greek bankers here, for the total of them, are you lending in your subsidiaries in the Southeast Europe? Because you certainly are not lending much in Greece, or that's what the data shows. The lending here has come down sharply. So are you going to be a part of the solution in the southeast of Europe, or part of the problem?
Okay, first I've been wanting to give my take on Achilles since William started. First, I'd say that Achilles was a guy who was invulnerable, apart from a small part of his body, which was due to his mother being sloppy when he dipped him at birth in the Styx. The other thing, and that was taken advantage of by Paris, who shot a well-aimed toxic arrow at his heel, and it is understood that at the time he was wearing sandals, which didn't give him a lot of protection. At least I saw that in the film. Now, we are not Achilles. So the question on whether this is the Achilles heel is neither here nor there. We're not Achilles because we're not invulnerable. I agree with both William and Themos that we are, that the greater risk is in Greece. You know, that's where the head and the heart and the other vital organs are kind of generally situated. 18% of our loans are in Romania. 79% are in Greece. Non-performing loans are rising in both in Southeastern Europe and in Greece, pretty much at the same rate, although they started at from a lower level in Southeast Europe. So I believe that the rate of growth in Greece is going to start declining faster than it will in Southeast Europe, which means that the maximum non-performing loans will be reached in Southeast Europe at a later date. Then it will in Greece. I also agree that the absolute level of non-performing loans in Southeast Europe and the expected losses will not be a catastrophic event. And the operating profitability of the banks will be sufficient to cover these losses without loss of capital. Now, we are doing the stress tests, obviously, but even with stress tests, we can see that the capital adequacy post-crisis is going to be lower than the 8%, but is still going to be quite sufficient. And an observation in general that capital is there for the expected losses or the unexpected event that the expected losses are going to be higher than the operating profitability allows you to eat up. If you knew for a fact that the crisis is over and you're not having any non-performing loans, you could operate as a bank theoretically with €1 of capital if you knew it for a fact. You don't know it for a fact, which is why you have to keep this capital aside. If you eat up part of the capital upon exit from the crisis, it is not a disaster. You will build it up again. So you're ready for the next crisis. Now, next point, it's still very important for the banks to be there. We buy the macro case. We buy the convergence story. That's why we went in there in the first place. And I believe that in the years to come, the Southeast Europe is going to be a market that will thrive. The Romania, which is the biggest Southeast European country or the economy, has a structure where industry, the GDP is made up 36% from industry. This compares to 30% for Germany and 23% for Greece. This is quite a big manufacturing base, and they are an export-oriented country. Its main partners are Italy and Germany, make up 35% of its exports. Once they start moving, Romania is going to be reasonably quick to pick up again. So I'd say that we are going to be there. What is happening now is that the demand isn't there. You have, and it isn't in Greece either. The requests for consumer loans or for mortgages went right down, went down by 80%.
That's truly
It's
psychological.
picking up. It may be psychological. It may be that the criteria, the risk profile has gone up, right? Some people, if you're self-employed, you will have witnessed a reduction in your income. It is more difficult. Banks will not give money to people when they're reasonably sure that they won't get it back. And this phenomenon has increased. So more people are seen as higher risk, and you wouldn't want to lend to them. Other people that you do want to lend to are in psychological shock and don't want to borrow. And so, but we are getting our loan portfolio repaid. Our average life for our loans is 3 years. in Greece. So if we've got 30 billion of loans in Greece, 10 billion approximately get repaid every year. If our balances stay the same, that means we're giving 10 billion of loans. That allows the economy to recycle itself. It provides working capital. It allows, what doesn't provide working capital is when the government does not pay its providers. That siphons capital out. Very good for Greece would be if the government were to pay the people it owes money to, and then that would also, that's 12, 15 billion, I don't know, there are lots of numbers that are flying around. That would be very helpful. It would have a multiplier effect. It would have a big multiplier effect on bouncing checks, which are the method for people between, disintermediating banks. That's how they would finance each other, by giving a check which gets passed around. So I think that the multiplier is like 5 or 6 times. So you get 15 billion coming in, that makes 90 billion of checks kind of not bounce. That would be good for the economy.
So you say that there is not much demand for new loans. It's not that you as banks do not want to give loans, or you do not have the capital to give loans.
On capital, one easy way and a different metric, I think the numbers are right as they are measured. But a leverage metric is not being used here, and it would be useful. So if you take tangible equity to tangible assets, that is a metric that is used quite a bit in the States. It's not really used in Europe, but it is coming into fashion now. We have 5.3% equity to assets. That is a very, very high ratio. And it is a ratio that reflects real money equity, no funky stuff, to assets with no risk weighting. Again, no funky stuff. So it is a pure number. And we've recently reiterated that we're very comfortable with our capital position. We do not have a problem with our capital. We do not really have a problem with liquidity, which was not the case in the last quarter of last year. Liquidity was the main issue. Now markets are beginning to open up. We've come out with a 2-year bond. It's expensive, but it's certain.
Yeah.
The cost of deposits is beginning to come down, as that nice graph, I hope, continues, showed. And the loans are getting repaid, which of course creates liquidity, which you can then give out. We do not have a problem with that. Demand is down, and risk is up. So credit cards, for example, are not doing well. Credit cards, that means that if you were approving 40% or 50% of applications last year, now you may be approving 10% or 15%. You need to be more careful. But the demand is one of the key drivers to why the loan growth is not going up.
So you seem on a very strong position. So if you haven't, now because you haven't gotten much money from the government, it seems to me that you're ready to repay the government their portion in the stock of Piraeus Bank.
Are you trying to get a news item?
Of course.
No, I'm not going to tell you anything like that. We have accepted...
You could do it if you wanted to.
Most of the Greek banks could do it.
So?
So?
What's the problem?
The problem is that we've already taken the decision that, well, when we took it, we still had a reasonably a strong capital position. However, you and your colleagues made absolutely certain that anyone who was not going to take the government money would be viewed as the one having the biggest problems. And you were suggesting to people that the bank would go bust, and therefore people were taking their money out.
No,
I have absolutely no certainty that you won't go into a second round if we decide to repay the government.
If we're talking collectively, not about
I am
myself.
talking
I'm
collectively
sure,
about your species.
I'm sure my species would do exactly that. They always do. And that doesn't mean they're right. That doesn't mean that there wasn't the Marfin exception and it wasn't penalized. Anyhow, what is the view of the banks from outside of Greece, the bankers? What do you think about this issue? Would it help us in the credibility side to repay the government and thus be even stronger by going out and competing in the southeast of Europe?
First of all, you allow me to add some comments, good comments, to Mr. Manos. It's not there is no demand. Also, the banks have been more wise now. They become more wise. They understand the risk there is around. They understand now they have to manage their capital in a better way and to increase the standard of the credit worthiness. In other words, they are careful where they have to give their loans now, and they are passing on, I say, to the people they ask for loans in more, they ask in more criteria. They ask to be more credit worthiness. They are not giving now as they used to be before the crisis. Now, that's a good thing. I'm not saying you are doing something wrong. The point is that it's not only there's no demand. You are more careful where do you give loans. Now, if I understand your question, Mr. Zuni, you asked me about money that they will given to the Greek banking system in order to improve the quality. What do you ask me exactly? Because I do.
It's generally, I actually asked more the people from abroad, how do they view this process if giving back money to the state would make the Greek banks seem more strong and thus more able to compete in the southeast of Europe? Do you think they should give the money back? Is that a pro?
I think they know what is the time to return the money back. They know that.
So you leave it to the banks themselves? Okay.
I can tell you when the right time will be.
When?
And it will be when we are certain, or 99.5% certain, as a collective group, that we know what the maximum non-performing loans will be.
Excellent. So that will take at least 2 years, 3 years?
No.
Because the presentation of Goldman Sachs and Deutsche Bank said that the non-performing loans will be rising for 2 to 3 years.
It had 3 data points, actually. I don't remember which countries. 2 of them were actually declining in November, in 2011, so the maximum was 0.10. So that was a mistake you made there.
No, I agree.
You should read the numbers. Not just
2010,
listen
then
to
we can decide.
I think it's important to, about issues of confidence, I think what Mr. Mano says is that certainty about the final outcome of NPLs will come much earlier than the LPLs actually peak.
Okay.
So we'll have a much better view.
You will know earlier.
Yeah.
Correct.
Excellent. So the important thing now is about the actual economy. We speak about the banking system, but from your shoes as an investment banker, we'd like to know, is there meat in the southeast of Europe? Is there actually a case for the Greek, for the actual economy, for Greek banks to loan to credible businesses? Will this data, in your view, and I'm speaking very practically, as a practical man who does business there, who knows people there, people, institutions, who knows how the educational system works. Do you think that these countries will actually deliver?
Sure. I'll just make one comment before, which everyone's been talking about capital.
Okay.
The way I look at capital is it's there to protect depositors. And it's not there for any other reason.
Okay.
If you think, when I come to Greece, I look at the Greek word for a bank is a table, I think. Everyone's forgotten that, right? Someone gives you the money, you stick it under the table, you charge them some money for keeping it, and you lend it out the other side. People have forgotten that's what capital is all about. So the capital debate, to me, is simply one of a balance between protecting your depositors and improving your shareholder returns. And that's the trick. And I think that all the stress tests, my other comment on the stress test is that when you're stressing for a Six Sigma event, whatever it is, and you're in one, it's kind of tricky because you're in that Six Sigma event at the moment. That's my comment on the capital and the stress tests.
Okay.
On the Southeastern Europe bit, I would not profess to be an expert. I will comment on what Dimitris Statokopoulos said, my colleague this morning. You know, we do a lot of business in Serbia, Bulgaria, Romania, and there has been a slowdown in the level of that activity. But I think you have to look at people like the IMF, look at the ECB, the EBRD. They have been putting money into the country because they believe, you know, if we can get ourselves through this climate, there will be a recovery. There have been some mistakes. I think there have been quite big mistakes. I think the world is viewed as there is. The EU, Bulgaria and Romania, EU countries, EU convergence. You know, Barack Obama's reminding all of us we should be letting Turkey into the European Union. Good of him to do that. You know, I see no doubt why there won't be. Will the growth be as quick as it was when we were building our models in 2007? Possibly not. But to my mind, we're expect to be pushing the J curve is being pushed out 2 or 3 years. That's my conclusion. I say the conclusion is, should the Greek banks be in Southeastern Europe? I think they have to be in Southeastern Europe because the size of the Greek economy is such that if you want to see the growth, that's where it's going to come from.
Good. So, Mr. Fiotakis, do you think there's something that the Greek banks are doing wrong at this point? Do you have any suggestions?
I think that I would not want to, because I mean, Goldman Sachs is an institution that has specific people talking about specific things. So we have people talking about Greek banks specifically, and I'm not one of them. So I would not want to make specific comments about banks. I want to make one particular comment about the issues that we're discussing. It's the fact that confidence in the system is not something that is exogenous completely or depending on psychological mood swings. It depends on how the market and the system behaves and delivers. And as soon as Greek banks, there's more certainty about Greek banks, the Greek economy, the Eastern European economy, what is the maximum amount of losses, what is the actually, you know, the worst case scenario, the markets will assess these risks and they will put money back to work. I don't think that markets are seeing things in a bipolar way. They're trying to assess the risks, and there will soon be more certainty. That is one point. The second point is that obviously during times of recessions, there is lower demand. I think what Mr. Manos says is very right, that there is lower demand all over the world for less financing. And when people are seeing loan growth coming down, they should really understand that in a recession, that's what happens. And the final thing is that a lot of these things that we're observing, it's very easy for people to start pointing the finger. Oh, it was the agencies, or it was the banks, or it was the regulators. It's very easy, but these are macro-systemic events. We're in a global environment. Monetary policy is global. The actions of the Fed, the actions of the Chinese central bank, the actions of the European central bank affect liquidity globally. And when money is globally cheap or globally expensive, that affects everyone. So it's worth putting these things into a framework and to think about them in the broader picture. There was an issue with oversupply of capital or oversupply of liquidity in the past few years. Then, over the crisis, there was an issue of withdrawal of that liquidity and deceleration of the system. And we're coming gradually back to a more realistic environment in the global markets. And as global markets start to recover and to assess risk systematically, there is money to be put to work, and we will put to work wisely to the places that deserve to be financed, I think.
Excellent. So the last million-dollar question goes to Mr. Manos. Now, we are here at this event, and we say some things, and people want to take these things we say and go home and act on them. But after we leave here, things might change. Okay, so I want you to tell me, what are the signs that an investor or someone who looks at the banking system could read in the papers and see that something that we said today has changed to the worse? What are the leading signs of, let's say, problems, actual problems for the Greek banks in the southeast of Europe? Let's not be just waving this contingency. Perhaps something will happen tomorrow which will make Greek banks have problems in the southeast Europe, or have you ruled that completely out? Is it easy going from now on? Can you give us some signs that say, okay, if you look at this, if something like that happens, you should be wary? And that is a question also to the economists here. What should we be looking at as problem signs Or if you want to look at it from the investor side, what should I be looking as a sign, you know, in the papers, not in a conference from Mr. Manos, who knows about it, that things are actually so much better that we are past the problem stage, and now I can perhaps invest with more confidence in the stock exchange, in the stocks of the banks that actually are in Southeast Europe, because later on we will actually see profits.
Right. Okay. First of all, that's not $1 million question. Our market cap is close to 3, and we're talking about bigger numbers, 3 billion, right? So it's bigger numbers. Secondly, I am not ready to say that our problems are done in Southeast Europe. I am saying that it seems unlikely that we are going to have a capital adequacy problem born out of Southeast Europe.
Okay, that's important.
When I am ready to say that that it is now easy going, it is going to be too late for you to buy my shares, because the price will have gone up quite dramatically. So that's one. You need to make a bet. I'm not going to tell you what the answer is. If you're reading the papers, so first of all, as soon as we walk out here, some things will change, because they always do. It's the random walk thing. What William said before is that there is an expectation of increasing non-performing loans, and showed us some data as to what the expected non-performing loans might be in different countries by when. So what could get worse is that the non-performing loans would be higher than consensus view, and that it will keep going up for longer. And so that's one thing that could go bad, and I guess you try to read the trend lines on what non-performing loans are doing and try and make your own projections. If the IMF gets up and walks away from Romania, that's bad, because it creates economic stability, and it is increasing. And while it's there, the banks that are cooperating with the IMF and the central bank there are also committing not to take liquidity out of the country. So you're getting money flowing in and money not flowing out. That creates a lot of liquidity in the system, which will be used as a buffer while the economy gets back on track.
Important point.
So if the IMF walks away, that creates a bigger issue. Again, it's a bigger issue because in absolute terms, it may be bad for Austria, but Austria will have a problem if Southeast Europe has a problem, perhaps. Greece will have a problem not because Austria has a problem, but because Southeast Europe has a problem, because it's the same problem. But for Greece, it is non-catastrophic, although it will have domino effects that Austria will affect Italy, and Italy will affect Greece. Italy is a big trading partner of Greece. So if it's not doing well, it has impact. So it's one big puzzle. Political instability, if you have large increases in unemployment, it may lead to social unrest and demand for higher wages or for greater protectionism. Those are generally bad for economic re-energizing. So IMF walking away, higher increasing unemployment leading to social unrest would be bad.
What's the good
Then
stuff?
you have the...
Mr. Noosa, any pointers?
Oh, he doesn't want to know the good stuff. He wants to write about the bad stuff. Earthquakes, fires,
I completely agree with you.
plagues. Yeah.
To me, the question again is just the length and depth of that recession. And I think you need to start looking at what those indicators are for what's going to stop this global recession. I think decoupling is debunked. I think that there is such an integrated... We spent 20 years globalizing ourselves. Trying to unglobalize ourselves in 18 months isn't going to work. So I'm afraid to say I think Luigi was on the money when he was talking about the US. I think if you start looking at positive signs, start looking at US unemployment and start looking at US house prices, because that's where much of their wealth is. If they stop being unemployed, think they're rich again and start consuming, then good things will happen. The Chinese will start exporting, et cetera, et cetera. So if I want to look at the positive signs, I'm afraid saying take it well out of the Greek equation, I'd look over to the US.
Excellent. The good sign is that we tend to agree that the worst thing that can happen is that the recession is much more prolonged. So are there any questions from the audience? Or did we cover the whole of the issue?
Or put them all to sleep.
Don't be afraid. We try to be candid. It seems that we have no more questions. If anyone wants to make a final...
I can say that it's a common ground that the Greek bank is definitely less exposed than the competitor, for sure. I'm 100% sure it's very, very unlikely IMF to leave the region. It's an international crisis, and they know they have to find an international solution, and IMF will play a catalytic role there. Although things have to be changed, as I said, and I do believe that the first 2010, we will see sign of better off situation. We see sign of less suffering from this area.
Excellent. That's good news. I want to thank the panel, the panelists. I want to thank you for staying late. And as the publisher of Trima magazine, I think we should all go there and buy our stocks early, since if we are a long-term investor, it seems that things are going to be rosier. Thank you very much for your attention.